You're listening to the Option Alpha podcast from optionalpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at optionalpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from Option Alpha, working every single week to make this the most popular investing podcast offered online because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thank you so much for tuning in to today's show. On today's show, we are going to be talking about the 11 common options trading mistakes and asking and wondering if you're making any of these mistakes. And I would bet that many people are probably making at least one of these mistakes. I know I have before in the past for sure. And that's why I created this podcast and this list. Now, I want this podcast to be used as an ongoing reference for you. So if you were sent this show from me or from my team, it's probably because you might potentially be making one of these mistakes. And we'll go through all 11 of these as we move forward in the show. But I do want this to be an ongoing reference for you. So I encourage you to not only listen to the show today, but come back and listen to the show in another month or so, in another 2 months. Just put it on your calendar, add it as a reminder in your phone, because I can't stress enough how important these concepts are. These concepts to me are the foundation, the bedrock of what we try to do as option sellers. And you start picking and choosing from this list, and you really can see how quickly you can get yourself into trouble, especially during what we just saw in the last couple of weeks or so in the market with all the volatility that we've seen. We've actually done very well during this environment because we have really stuck to this list and stuck to our guns during different times in the market. So I want to go through this list. As always, if you guys want to get a copy of the show notes and you can see this list or see any of the notes from our team, you can head on over to optionalpha.com/show 146. Again, that's just the number 146, optionalpha.com/show 146 on the website. So the first mistake that many people are making, for sure, 100%, has to be the first mistake, because I see it all the time and I press people all the time on it, is position size. Position size still remains, as much as I've talked about it ad nauseum here, that position size is absolutely the biggest mistake that people make, in that they position size too large. They get into positions where they don't actually calculate it. They think they're calculating their position size, but they're really not calculating it. And they end up getting into a trade that is way too large for your account. Now, remember, the only thing that really kills us long-term is sequencing risk. We talked about this in a previous podcast here. And let me pull up the show notes because I want you guys to go back and look at this one at show number 140, or I believe either 139, where we talked about sequencing risk. But sequencing risk is really the only thing that can kill you in the market. This idea that one bad trade that could be followed by another, because bad things happen to good people and we get into market environments where you get a string of bad trades, that's the thing that really kills traders. And so if you understand that that's really the major thing that could kill you, then position sizing has to be something that counteracts that. If you have a small position on, nothing should really kill you. I got a lot of emails the last couple of weeks during the market meltdown of people who said, I'm being killed on this position, or this position is absolutely destroying me. The huge losses. I mean, all of the favorite quotes that people have about trading. And what I started to really press people on, and I press people hard on this because I want them not only to understand, but I want them to see it for themselves, what their position size was during that trading environment. And more often than not, I'd say 99% of the time, the problem was position size. You had a position that was over 5% of your account. And that means that all of the trades combined for any one ticker symbol cannot be more than 5% of your account. Look at any professional trading strategy. Look at any professional trader. They will tell you for sure that position sizing, risk management, whatever they call it, it's the same thing. We're all talking about the same thing using different terms, is the number one thing you should do. So that's probably the first mistake that many of you are making. And it might be hard because you think you need to allocate more money to a position or to a strategy to make money, but you don't. Position size helps you. It saves you. It's your friend. So use it appropriately. Number 2 is low trade count. So I see this a lot too, is that people get started in this business and they think 70% chance of success means that every trade or the first 10 trades are going to be winners, right? And I don't know what to say other than it's a probability game, which means that there is a probability that you lose. And 100% when you lose, it's probably going to be a slightly larger loss than what you might make when you win. That's how a high probability system works. But what many people don't have the stomach for is the ability to trade long term so that your trade count more accurately reflects the expected outcome. And so, what do I mean by this? If you make 10 trades and they're all at 70 or 80% probability of success, legitimately, all 10 trades could be 100% losers. You could lose on all of those trades. Now, that's not the likely outcome, but it's a possible outcome. That's where this sequencing risk that we talk about comes into play. You could just literally have such bad luck at this exact moment that you walk into the next 10 trades just when the market is absolutely collapsing, or just when a stock is about to make this huge run up. And so the problem is that if you don't let yourself or give yourself the expectation of trading a lot of positions over time, anything can happen in the first 10, 20, even 100 trades. After 100 trades, you really haven't yet even solidified your win rate. Win rates really start to solidify once you make 200, 300, 500 trades, which is just another fancy way of saying you've got to be in this business long term. You can't just dabble in this business and dip your toe in it and hope and pray and dance around the idea that maybe you're going to make some money or not. You've got to physically commit and mentally commit to this business and understand that your best friend is longevity. And the more you can stay alive, through position sizing, through all the other things that we're going to talk about, the longer you trade, the more solid your trading strategy is going to be and the more likely you're going to be to hit that expected outcome. So if you're having issues right now, potentially it could be just that you have low trade count. It doesn't necessarily mean that you're doing anything wrong. In fact, a lot of times when people come to me and they say, Kirk, I have these, positions and they're losing and whatever, and they're just making the right trades. They just feel like they're not doing something right because they're losing, but they're making the right trades. They just might have run into a bad string of trades, and that happens to all of us. Number 3 is diversity of tickers. So again, if position size becomes insanely important, one of the things that is maybe the next in line to position size and trade count is having a diversity of tickers that you're trading. Now, a lot of times people will come and say, well, Kirk, why can't I just trade the S&P? Or I back tested this strategy and it outperformed the market, so why don't I just trade one ticker? And you can. I'm not saying you can't. But here's the risk in trading just one ticker. The risk in trading one ticker with, say, 30 or 40% of your account and only focusing on that one ticker is that you have a ton of risk if that one ticker starts to go crazy and haywire. And I personally don't ever want to be in that situation. So although a backtest might show that just trading SPY or just trading IWM is profitable long-term, you still are putting all your eggs in one basket. And in case something happens in the future that we haven't been able to get data on, maybe a black swan event that we've never seen before, a market downturn, a market rally that we've never seen before, we don't have data on, so we couldn't have even included it in backtesting if we wanted to. That's a lot of risk focused in on one ticker. My opinion is you should at least have about 10 to 15 tickers a month. And we talked about this again in one of our previous podcast episodes about sequencing risk and how many tickers and how many trades you should get into. So you want to go back and review that one. That's show number 143. But I think you should have, around 10 to 15 tickers if you can every single month. And that gives you a flexibility in having one or two trades that might go really bad, but not blow up the portfolio. Case in point from last week. So last week when the market had a huge down move, right? One position that's been moving against us recently is TLT. But during that huge down move, TLT was up, which was good, right? Didn't make back everything that we have paper losses on TLT right now, but it was making back some money. But everything else was moving the right direction for us. And so if we only had all of our money in TLT, we'd be really, really struggling. But last week when the market had a huge down move, it was a great day for us. We had a lot of profits come in, more than overshadowed TLT. And it's because we had a diverse set of tickers. We were trading a lot of different things, and we kept scaling up the number of tickers that we were trading. Number 4 is portfolio balance. So again, I'm just continuing to build, hopefully, this foundation. We're starting with what I think are probably the most important blocks and then continuing to layer on top of these. And these are not hard concepts. You just actually have to do them. That's probably the hardest part, is actually just where the rubber meets the road. It's actually doing the stuff that you need to do. But number 4 is portfolio balance, because what you can't do anymore is be a one-sided trader. Like, I don't understand. I actually struggle to understand why people would want to be one-sided traders. It's just too risky. And last week proved that, with the market having a huge down move that literally wiped out months and months of gains. And in the case of the Russell, practically wiped out almost an entire year's worth of gains in literally an instant. In a day, it wiped it out. Now, look, I don't know if you think you have market timing superpowers. Some people think that they do. And some people would say, well, Kirk, well, what if you got into the market and then you got out right before the top, right? And they, do that like song and dance that I haven't heard a million times before. But who's to say that you're always going to be able to pick tops and bottoms? I know I can't. I can't pick tops and bottoms. Can you? Like, nobody can do this on a consistent basis. So why do we act like we should be one-sided traders? It completely blows my mind that people do this anymore. If you're going to be trading options, you need to do so on a portfolio neutral basis. It's what the largest institutions, the biggest hedge funds, the largest high frequency shops do on an ongoing basis. They are neutral to market moves. They might pick and choose directions or certain securities, like you might be, bullish on bonds and bearish on gold, but just be overall neutral to a lot of the market movement, so that one massive move in one direction or another does not hurt you. And this also takes advantage of just profiting from the slight fluctuations that we have in the market every single week and every single month. So instead of picking direction every single time and having a 50-50 shot of winning, why not pick a range? Why not just say, hey, look, I don't care where the market goes as long as it stays in this, 200-point range. And then generally my mix of trades is going to make money. So I believe that you should be more balanced than not. Again, that's not that you can't take directional bets. Just don't take all the directional bets in the same direction. If you're bullish on Facebook, be bearish on Twitter. Take a opposing view just in case you're not right. Number 5 is option buying versus selling. This gets down to one of the core fundamental flaws of options trading that I see a lot of people do, and that's just going out and buying options. Now, many people get started doing this because it's easy. It's easy to hit the buy button, limited downside, unlimited profit potential. I get it. I get the rationale and I get the logic behind it. The fact is that it just doesn't work long term. As option buyers, you end up paying the implied volatility premium. And guess who you pay it to? Me. So thank you for all of your contributions if you have made those contributions over time. But look, option buying does not work as a long-term income strategy. It just doesn't do it. If it worked, then what you would see is insurance companies starting to hope that people's houses burn down, right? And that's just not the case. It's the same methodology for insurance, for casinos, for all of these. It just doesn't work. And so what you have to do is you have to be more of an option seller than an option buyer. Now, does this mean that you can't do option buying strategies? Of course not, but just keep them very small in your account. Use them for hedging purposes if you want to. If you want to take a directional bet and you want to, shoot for a home run or swing for the fences, fine. Just don't do it with a large amount of your money. I don't do it with any amount of my money. So I will not buy options as a core strategy with anything because I just don't believe in it. But if you want to do it, fine, do it. But just do it as a small portion of your account. Number 6 is using stop loss orders. This to me is a really big one because what we've proven time and time again is that stop loss orders create more losing trades. In fact, if you actually go back to show number 67, which is a long time ago on the podcast, but show number 67, we went through 10 back-tested strategies that prove that using stop losses in multiple environments, in multiple situations, creates more losing trades. Again, I don't know why people have not caught on to this. And it's because I think just frankly of the terminology. We hear the word stop loss and it's going to stop us from losing more money. But in fact, these things should be called more loss orders because they create more losses. They end up getting you out of a position at the most inopportune time when the market is just going through some fluctuations and gyrations. Using stop losses as a core strategy is not good for your portfolio. So the better alternative to using stop losses is just frankly to position size better. Risk adjust your positions appropriately so that if you have a max loss or near max loss on a trade, it does not kill you and it should never knock you out. And you definitely shouldn't lose sleep over it. Okay. Number 7 is not exiting positions early. So this is really when it's favorable, when we backtest strategies or when we use the trade optimizer, when we know that exiting early, and in many respects, exiting early ends up increasing our win rates, ends up reducing the time that we're in the trade. It reduces drawdowns. It allows us to more quickly recycle capital in our account. But using these exit targets is a very viable strategy across the board for increasing returns. Now, again, I understand the confusion here. The confusion here is, well, if I'm trading $100 credit and I have to buy it back at 25 and I only make $25, I leave a bunch of money on the table, or how can this possibly work? And it's because when you reduce the risk in the trade by getting out earlier, not letting the market move against you, taking what the market gives you, you dramatically increase the likelihood of success. Remember, we are just option sellers that are looking for highly opportunistic exits. So we put on a lot of trades, and then when the market moves in the direction that we want, we take a trade off. And if it doesn't, we generally just are patient and let the market continue to move and continue to ebb and flow, and we'll be opportunistic about how we exit positions. Number 8 is that your total account allocation is too high. Now, this is different from number 1, which was position size. In number 1 of this list, I talked about the position size for each individual ticker symbol or trade that you make. No one ticker symbol can represent more than 5% of your account. In number 8, I'm talking about your total account allocation, meaning how much of your account is allocated to options trading. Again, we've done a lot of research on this, and what we generally find is that somewhere around 30% of your account tends to be one of the more optimal allocation zones. This means that 70% in some cases of your account on an ongoing basis sits in cash, not allocated to a stock, not invested in ETFs, not in a long option strategy, just cash. And yes, that cash is going to earn 0%. And it seems like that cash is going to be a drag on your portfolio, but it's not. Because when you have 30% of your account allocated towards an option strategy, what you're doing is you're allocating that money towards a highly leveraged product. Remember, options trading is highly leveraged, which means that when you win these massive returns on an option strategy on a small portion of your account, which more than makes up for the amount of cash that you have sitting in your account. So again, what a lot of people do is they over allocate on their account, and they basically try to front run all of these trades with a massive push in allocation. And what ends up happening is they get into a bad string of trades, because we know that that's going to happen eventually, right? A bad string of trades is going to come along. And when you're over allocated, you get wiped out immediately. You run into margin calls, all your positions seemingly fall apart, but it was your own fault because you allocated too much money. What we've seen time and time again is that when you allocate appropriately and you keep it, I say definitely under the 50% threshold, but say like 30-ish around that target generally, that you give yourself a lot of flexibility to go through what we had last week or what we had a week and a half ago in the markets when the markets were really crazy and volatility was up. During those time periods, we've got a lot of cash left as a cushion to pad ourselves. We're not forced to exit positions at the worst possible time. And that can be the difference between making money or not during a particular market down move. Number 9 is reducing commissions. This is a simple one. This one it could be one of the ones on the top of the list because it's really easy to do, but just negotiate with your broker or change brokers and move to a platform that has lower commissions. Now, you guys know, and I've talked about before, that I think what most of these platforms are going to be going to is going to be a free model. Eventually, all broker platforms will have free trading. I think we've seen it initially with Robinhood, now JP Morgan. Now there's another one out of the UK that's offering free trading. So all of these brokers are going to a free, commission-free platform. Use this to your advantage potentially to negotiate better commissions or reduce the commissions that you're paying. This is an easy win, right? It's reducing the fees as associated with your returns. All right, so number 10 on this list is adjusting to reduce risk. And I really should say that it's adjusting or the mistake that people are making is that they're adjusting to increase profit potential, but that's not what you should be doing. So what you should be doing when you make an adjustment is you should be trying to curb the loss that you have in that position. Now, a lot of people just generally throw up their hands and they give up, which is probably the worst thing that you could do, right? So if a trade's going against you, the worst thing you could do is just throw your hands up and say, you know what, forget it at the end of expiration. I'm not going to do anything. I'm not going to, adjust the trade. I'm just going to take the loss as it is. But there's probably a lot of things that you could do. I'm not saying in all cases, but in many cases, you probably could reduce the risk in the position. And my thought process along this is that if I can take a trade that should lose $700 and cut the risk down to $300, I'm okay with that. In fact, when I send out alerts to people or I do the video update and I say, look, we're going to lose on this trade, but we're going to make these adjustments so that we can lose less, that to me is a winning trading strategy, because not only are we managing all of the positions that are making money, right? So the positions that are making money, that's easy. It's easy to take profits off. It's easy to close winners. It's taking the losers and being able to cut those down in risk by rolling, by adjusting, by moving sides closer or not, by adding positions, turn a credit spread into an iron butterfly or vice versa. That to me is a winning strategy, because you are able to cut the risk in every single trade, or potentially most of the trades that you make. And that helps move us towards this positive expected outcome that we're shooting for. Number 11 here, and the last one on our list of 11 common mistakes, is fighting back. This to me is a big one. This is just an emotional thing that people do, a psychological flaw that we have, but we feel this need for whatever reason to fight back against the market. And this can rear its head in many different forms, meaning you can try picking the direction. You can try doubling down. You can try to look for articles that, basically confirm your biases about the market, that the market is going to go up or that the market's going to go down. Look, I used to do this a lot early on, no doubt. I was 100% guilty of this. I would manipulate the charts to my own to my own personal biases. I would look for reasons why I'm right. I look for, overlaps, like, oh, the 1929 crash and this crash, or the 1987 Black Monday versus this Monday. There's so many things that you can look for as, aha, this is the reason why the market's going down. And this confirms why I think I'm the way that I am. And it's really just because we don't want to come to the realization that secretly, we absolutely have no idea what's going to happen. And the sooner that you actually realize and accept that you have no control over the market and anything can happen at any time, the better off you're going to be. I have given up on trying to fight the market. I have learned many years ago that it is a constant losing battle. And even during the time periods where I was right in picking direction, or I maybe doubled down on something, or had some sort of biases that the market was going to move lower, or had some sort of bias that the market was going to move higher, those times when I was right, they are false positives. They're false positives because they give me some sort of hope, some glimmer of understanding that maybe I do have this, maybe I do understand the markets. But the reality is that we don't. We don't understand the markets. In fact, they surprise me all the time. And that's okay. I don't need to predict the markets. I don't need to predict where things are going to go. I just need to play the outcomes and the probabilities, keep my position size small, balance my portfolio, diversify the tickers, all the things that we talked about. You do that, you don't need to fight back against the market. So stop fighting it. Stop fighting it. Stop pushing back against it, and welcome the volatility, welcome the unexpectedness as your friend, because it is. Because let everyone else fight the market. Let everyone else try to figure out where it's going. Let everyone else double down on it. Have a million reasons why and a million support and resistance lines drawn that shows that it will rebound at this level and it's going to stop at this level, and let them all fall flat on their face because they're just trying too hard. So to me, I want to, again, end with this one, because most of trading, and we talked about this in a daily call podcast a little while ago, most of trading is the 80-20 rule, in the sense that 80% of what you do is just psychological. It's just in your mind. It's getting through the mental barriers that you have, put up in your mind, whether they are subconscious or conscious, that they're there. 80% of trading is that. The 20% of trading is just mechanics. It's just actually doing the process. It's going in and clicking or figuring out what to trade. And hopefully we're going to help with that with the auto trading in the future. So you don't have to do this. You can kind of, set up the system and let the auto trading bots take control if you want to. But a lot of this is just this mental barrier. So again, number 11, stop fighting back. So hopefully this list has been helpful. First of all, if you have enjoyed this, if you thought it was helpful, let me know. Shoot me a tweet, send me a message on Facebook, add a comment to the post, leave us a review. This to me is probably one of the best ones I think we've gone through. I have personally enjoyed going through this because it hits on a lot of things I talk about all over the place. And I wanted to consolidate this into one single podcast, which I think will be insanely helpful for you. Also, if you thought it was helpful, please share it with somebody. Share it with a friend, share it on Facebook, send it out in Twitter and LinkedIn. This is how we grow here at Option Alpha, is through word of mouth. People like you listening to this podcast right now, sharing this because you found some sort of value from it. So again, if you enjoy this, please share it. And as always, you can head on over to the show notes page at optionalpha.com/show 146 to get an entire list of these 11 common mistakes and some additional resources as well. So let's get into the Trader Q&A segment.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi, Kirk. My name's Alan. I'm calling from Australia, and I've been trading options for a couple of years. My question relates to whether or not you benchmark the expected return against the risk for credit spread trades, and if so, what is your methodology? I was thinking of employing the following methodology for credit spreads: the probability of profit multiplied by the amount of the credit divided by the probability of loss multiplied by the max loss. Do you think that's an appropriate methodology? And if so, what is the line in the sand sort of hurdle rate for you if using that methodology? Thank you very much. I love your work. Cheers. Bye.
All right. So Alan, thank you so much for your question today. And I totally understand what you're trying to do. It's a very common thing that people do where they try to calculate basically an expected outcome. So the likelihood of winning times the money that you win versus the likelihood of losing times the money that you lose. The problem with this, and we address this actually in show number 138. So if you have this same issue, or if you're thinking about this and you're listening to Alan's question and you're thinking, oh, that's probably a good model. I agree with the model on its foundational level. But the problem that we see is we see three things that don't really show up on the front end of this calculation. And this is what we've often referred to and we've called the expected probability paradox. So you can learn about it in show number 138, which is right here on the weekly podcast. But it's this idea that there's these subsurface things that you don't see happening that materialize after the trade is entered. Things like IV over expectation, profit taking, adjustments, rolling, pricing, etc. Those things are not necessarily calculated on the front end. So while it's logical and our rational mind wants to think that there's a way that we can figure out the best possible trade for the given moment, there's things that we just haven't even accounted for yet that happen on the back end. Now, that all being said, I would say that you would always try to go for the highest expected outcome trade, given everything else being equal, if you can, because that will set yourself up for the best chance of success heading into it. So if I look at a trade that has a 70% chance of success, and it's a $1 wide spread, if one ticker symbol is paying, 35 cents in premium, the other ticker symbol is paying 25 cents, they're the same trade. It might be a different ticker symbol, but I can diversify out of that if I need to. But I would take the trade with 35 cents a premium. If it's both a $1 wide spread, both 70% chance of success, one trade is paying more than the other. So why not go for that one first and then try to diversify around that? But again, I would check out show number 138 just to talk or see some more in-depth training and discussion about this expected probability paradox. So again, if you guys want to get your question answered here on the podcast, just head on over to optionalpha.com/ask, just like Alan did, and click the big red button in the middle of the screen. Leave me a private voicemail. Again, there's no software to download or install, and it's incredibly easy. So let's get into the closing bell segment.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I want to go through a trade that we made just the other day, and this is in SMH. Yes, SMH is our good old friend. We've made lots and lots of trades in SMH. Sometimes SMH behaves well, sometimes it doesn't, but generally this year it's actually been very, very profitable for us to trade SMH. It's had huge swings. This thing can have definitely some huge swings, but over the course of the last year, it's basically traded sideways. So we've seen swings from as little as $10 up to around $20 or $25 in a given month, and then it sometimes will reverse the entire move. It's actually pretty crazy to trade, but if you stick with it and stay position sized accordingly, you end up doing pretty well. Well, given that the recent move down in the market really took a toll on semiconductors, which is what SMH is, it's a semiconductor ETF, what we've seen again is a huge spike in implied volatility. And so when this happened the other day, we ended up selling another set of strangles in SMH. Now, again, what we try to do is we try to ladder into these positions, meaning we spread our trade entry out over time. So as SMH was moving down last week, we entered one set. Then SMH moved down again, we entered another set. Now we're entering another set here by selling, again, the most recent 15 delta options on either end. So we're trying to recenter the position over where the market's moving, taking advantage of the market movement down to ladder into and build a position. And we're just doing one contract at a time because we are doing this as a naked strangle. And yes, I do like to do naked strangles on SMH. I think that the premium that you collect is pretty good. I think that you can get really far from the current price of SMH, and the margin is not too bad to cover. So for our account, we like to do the strangles, but we just do them one at a time so that we have room to add multiple ones depending on where SMH goes. So in this case with SMH basically trading around like the 96, 97 range, we're selling the 106 call and we're selling the 87 put. So we have a massive, massive range here for SMH to trade in. As long as it closes anywhere between 106 and 87, which would mean, again, a huge reversal up or a continued massive crash down, then we have an opportunity to make some money. So again, look, this is a high probability bet. This is what it's meant to be. We know that we're not going to always win on this type of trade, but we are making a high probability bet, forcing the market to continue to make huge parabolic moves. And in the slight chance that, or in the greater chance that it doesn't do that, then we have an opportunity to make some money. Even if implied volatility calms down and collapses and the stock still has some big moves, we could profit very quickly from just the collapse in volatility because volatility is so high right now. So again, for us, what we're doing is just selling a very basic, very standard, one standard deviation strangle in SMH.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so thanks again for listening to today's show. And as always, hopefully you got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video training from today's show by going to optionalpha.com/show 146. Again, that's just the number 146, optionalpha.com/show 146. And until next time, happy trading.